one in San Francisco, totaling 502 units. So with those caveats, let me try to answer the fundamental question I'm sure is on everyone's mind, and that is, has Silicon Valley hit bottom? While there remains disparities depending upon the type and location of the property, it is my opinion that the worst is behind us, and there are reasons for some optimism. Cautious optimism, by the way. Of course, when you look behind at the depth of the economic devastation, it would be hard to imagine, short of another depression, what could really be much worse. To appreciate how far we've fallen as a nation, here are some of the grim economic highlights just 30 months ago. The stock market had tanked, unemployment had skyrocketed, housing prices had plummeted, home foreclosures reached record levels, banks had failed, much of America's financial services industry was in disarray, the auto industry was in free fall, and we were bailing out major corporations. I believe a depression has been avoided, no small part because of a series of reforms and actions by the federal government. 30 months ago, the government was finishing up TARP, which was initially intended to avoid more bank failures. In spite of what you hear, TARP has been a big success. Originally, the U.S. government budgeted $750 billion for TARP. The government actually spent, invested and loaned, $573 billion, while $332 billion has been paid back to the U.S. government as interest, dividends, and fees, or to repurchase stock warrants. The actual net outstanding right now from TARP's $500 billion investment is $103 billion and counting. That is 65% less than what the government put up to bail out the S&L crisis in the early 1990s. AIG, Citicorp, and others have rushed back to pay the U.S. Treasury stake in their companies. AIG paid back the U.S. government $51 billion, and the government is projected to make a profit from the sale of $32 billion in AIG stock. So what's the net effect with AIG? A small profit to the U.S. government. TARP invested $245 billion in U.S. banks. The U.S. Treasury has already received $244 billion as repayment. So it's a break-even. And when TARP, all the remaining investments are closed out, the Treasury expects an overall profit of about $20 billion. Taxpayers reaped a $12.3 billion profit from the U.S. government's $45 billion stake in Citigroup, when the government sold its 34% stake in common shares to Citigroup. The auto industry has stopped its free fall and is showing strong signs of recovery. General Motors has repaid all of its debt plus interest to the U.S. and Canadian governments. And in May, Chrysler paid back $7.6 billion in loans from the American and Canadian governments. So thankfully, there have been no new bailouts of major corporations, if you remember, that were too big to fail. The collapse of Lehman Brothers was the beginning. Think of what would have happened if the U.S. government had allowed, as many suggested, GM, Chrysler, AIG, Citigroup, and major banks to follow Lehman. TARP was a desperate program for a desperate time. Well, since I began my career on Wall Street many years ago, I've experienced maybe 4 major economic decline cycles. Excuse me. But the recent crisis has been more pervasive than anything I've experienced in the 45 years since I left graduate school for Wall Street. But as I said earlier, the future is looking more promising. Even job growth, which is still awful, is showing signs of improvement. In the first quarter of 2011, the unemployment in Silicon Valley dropped to 10.3%, a big change from January 2010, when the average was 12.1%. However, it still remains significantly below the national average of 9.2%. 12,000 jobs were created in 2010. 20% of all jobs created in California were right here in Santa Clara County. Nationally, however, at the current rate, it would take 6 years to regain the jobs lost during the Great Recession. California's unemployment rate remains virtually unchanged at 12.2%. And there are major cities like Fresno where the unemployment exceeds 18%. So it's all relative and often geographically based. Another indicator that holds promise for Silicon Valley is according to the Bureau of Labor Statistics. Our county saw the largest increase in weekly wages, 10%, during the second quarter of 2010. That means there is greater competition for employees and the high likelihood that companies will begin adding more employees. The lead story in the Mercury News on April 16, 2011 reported that local employment growth was first in California's 10 metro areas, with 3,300 non-farm jobs created. And there was something in the newspaper, I think yesterday, about the same thing. Unemployment, or employment, is critical to driving the real estate market. I don't think we will ever see a rapid recovery locally or nationally like we saw in the mid-1990s, right through the dot-com boom. When we closed the assessment roll in 2011-2012, I'm constitutionally required to close the assessment roll every July 1st based upon real estate values as of January 1st. When I closed the roll, the total assessed value of all real and business personal property increased slightly from $296 billion to $299 billion, a 0.88% increase. One of the few counties, I believe, in California that will show positive growth. You got to understand that while 0.88% is not much, last year we were negative. That's compared to last year, which was the first time since the Great Depression that we were as negative as we were. During the 8 or 9 years of what they defined as the Great Depression, between 33 and up, I guess, until almost World War II, the assessment roll in Santa Clara County was only negative 3 times in 9 years. And only one of those years was the assessment roll more negative than it was last year in 2010. Think about that. During the Great Depression, we had a 2.73 negative assessment roll last year. That's the first time that happened since the Great Depression, except for 1978 when we passed Proposition 13, but that was a political reason, not an economic one. So, while the county property assessments increased, there were major geographic differences, and this will be very important to you folks here in Gilroy. Cities like Los Altos experienced growths of 3.81% and 3.59%, while other cities such as Milpitas were negative at minus 3.48%. So let's look at all of the major sectors of real estate, and I'll comment on all of them. Multifamily. I've been pleasantly surprised by how strong the apartment market has remained. Locally and even nationally, the apartment market has been the nation's shining star that is not darkened. Vacancies are down and rents are up. And the result is major players like Serato and Speaker are back in that market big time, both in acquiring existing properties and developing. The reality is that the apartment market was never overbuilt like most of the other real estate sectors. In addition, as families are foreclosed on, they need homes, they need places to live, and the younger generation is slower to buy homes due to the tenuous employment opportunities and the very strict loan underwriting requirements. So people have turned to apartments for housing. At a recent conference I attended, a prominent speaker made a presentation on the difference in the mindsets between Generation X and Y and people our age. He said that older people believe that renting is throwing your money away. Young people believe that owning is throwing your freedom away. For the X and Y generations, the status symbol today is who has the nicest apartment, not who has the biggest home. Single family. Unfortunately, the same is not true for single family housing market. The combination of overbuilding and easy money created a perfect storm that dragged an already weak U.S. economy into the greatest recession since the Great Depression. In Silicon Valley, values declined as much as 50% in some areas. Condominiums and townhomes were especially hard hit. As of January 1st, 2011, that's the valuation date of this roll that I closed in July, approximately 27% of all single-family homes in this county That's nearly half. 27% is nearly a quarter of the single-family homes, and half, 489%, of all condominiums. A total of 122,000 properties, almost 1/4 of all properties in this county, are assessed below their purchase price. There were dramatic differences in different parts of the county. One of the predictable indicators, I believe, is the quality of the schools. Neighborhoods with excellent schools experience fewer declines in market value. The opposite was also true. 1/3 of all homes that received a reduction in value in my office in 2010, and I don't have those numbers yet for 2011, were located in one single school district, the Eastside Union School District. Not surprisingly, this school district was also the epicenter of foreclosures. At the height of the foreclosure crisis in 2008, there were over 6,200 homes in Santa Clara County that were foreclosed, a 400% increase over the previous year of 2007. And while the number of foreclosures has gradually declined, it still remains way too high. Last year, there were 4,240 homes foreclosed on in Santa Clara County. Last year, over 10,000 properties recorded a notice of default, which precedes a foreclosure. And while many of these were sold or there was a workout arrangement with the lender, it is an indicator of the ongoing stress on the residential real estate market. It is estimated, and this is amazing, it is estimated that nationally, 70% of the loans that have already received a modification from their lenders will redefault. Think about that. In certain selected residential markets, we are beginning to see, however, more transactions. In some cases, multiple offers and sales above the asking price. Of course, these sales prices are far below the historic highs in 2005, 6, and 7. Residential property values in high-end areas, Palo Alto, Los Altos Hills, Cupertino, South Sunnyvale, Saratoga, and Los Gatos, remain relatively stable. We recently partially restored, as a matter of fact, in this assessment roll, the assessed values on 45,773 properties, which were previously reduced. That reflects, I believe, a positive trend. Talk a little bit about office and R&D. Remember those unemployment numbers that I mentioned? I think we are just beginning to see a positive impact upon office and R&D leasing and hopefully construction. While tenant demand is encouraging, it's weighted toward credit companies with strong earnings and excellent balance sheets. For the last several years, I go up to Sacramento a lot. And I live in Sunnyvale, and I live right off of Highway 85 Fremont, so I get on. So when I go to Sacramento, I drive from there to 880 in Milpitas. Less than a year and a half ago, two years ago, I would make that 8-mile drive, 10-mile, I don't know what it is, and drive by 6 totally vacant office buildings. Okay? Just shells. Property was landscaped, the parking lot was striped, and there was no one there. That is beginning to change very significantly, but slowly. So these are important aspects of change, I believe. There have been significant office activity leasing in the first 6 months of this year. Office vacancies in the first quarter of 2011 versus a year earlier declined 15% and rents increased 1.2%. R&D properties are not so robust. Vacancies declined 3.6%, but rents actually went down 7.1% in Santa Clara County. The first half of this year, this is a real success story. The 7-building office project called Moffett Towers. You may see it if you drive by Moffett Field. It's a beautiful building. 7 buildings, 1.85 million square feet of first-class, Class A office space. It was totally vacant for almost 2 years. In 6 months' time, they leased 1.1 million square feet of Class A office space of the 1,850,000 square feet to tenants, HP, Rambus, Motorola, Microsoft, Comcast, Quality tenants, good balance sheets, with a lot of upside. Nokia has expanded in Sunnyvale. In San Jose, the decision by Price Waterhouse to move down the street at least 9 floors of what I call the Sobrato building, that was the one that was vacant for about a dozen years, is very encouraging, even though they're leaving space in downtown Sunnyvale, downtown San Jose, but they're expanding their operation there. As the office market gets tighter and rents increase in Palo Alto and Mountain View and Sunnyvale, the tenants are looking south to San Jose with plenty of vacancies and lower rents. Microchip Technology announced last week that it is vacating its Sunnyvale location and leasing 98,000 square feet in San Jose. Major credit tenants are in the driver's seat for the foreseeable future as they seek out high-profile Class A buildings for nearly the same rent that they were paying in the older buildings if they were on a long-term lease. Increasingly, Class A buildings are not only being sought for their high-profile location and amenities, but the opportunity to occupy a green LEED certified building that is energy efficient is good for the bottom line. So the green trend, folks, is here to stay. Lease renewals were also prevalent throughout the valley, including Palm's 288,000 square foot lease in Sunnyvale and NVIDIA's 500,000 square foot lease renewal in Santa Clara. These leases, as well as Apple's purchase of a major group of HP properties in Cupertino, Google's land bank acquisition in Mountain View, and Facebook's purchase of the Sun Microsystems property in Menlo Park, indicate a high-tech's confidence in Silicon Valley. And quite frankly, most of the high-tech companies, from old-line companies like Intel and AMD to Cisco, and the internet and social networking companies like Facebook, Google, LinkedIn, so forth, have weathered the financial crisis because they never overextended. During most of the difficult economic crisis that we've experienced in 70 years, many Silicon Valley companies have improved their balance sheet, and it has put them in a great position as we continue to emerge from the recession. It does not hurt at all that these companies are at the heart of the innovation economy touted by President Obama and Democrats and Republicans alike. Major Silicon Valley corporations have 28% more capital than they had during the apex of the dot-com boom. Interest rates are low, and credit and capital is more available, but underwriting is extremely rigid. Leverage can range from 40% to 70% depending upon the credit of the tenant or buyer. More loans today are also full recourse. But obviously, if you can borrow money and you have capital, it is a great time to buy. Interest rates are likely to remain low. The land values should remain stable until rents and absorptions move up significantly. But credit remains tight. I believe the office market is poised for a modest recovery in 2011, which I had not previously anticipated. Property values are still below replacement cost, so you won't see a lot of new developments except maybe in the apartment market. Now, recovery does not mean that things will return to the dot-com boom times, but it does mean we are heading up, cash it slowly, in 2011. How long before we get back to some semblance of normal will likely have a lot to do with bigger factors such as employment and consumer confidence. As consumer and corporate confidence improves, so will the office market. It is also important to keep in mind that not all markets are the same. The Palo Alto office market is literally on fire, with vacancy for Class A buildings at 2 to 3%. Mountain View is also strong, largely because of Google, and Sunnyvale is finally improving in the downtown area. In general, market activity is far more robust in North Santa Clara County than in San Jose and South. There's still 40 million square feet of vacant space south of Sunnyvale. Warehouse and industrial sector. Another sector I want to touch on is the warehouse and industrial sector. While vacancy remains double-digit, the sector has not been as adversely affected as the office and R&D market for the simple reason that just like the apartment market, it was never overbuilt during a period leading up to the Great Recession. According to Grubb & Ellis, they reported the overall vacancy rate decreased 200 basis points to 15.6% last year. it is likely that the struggling solar industry, if it can find its firm footing, could become a major player in this sector. 90% of all U.S. solar production is in California, with companies like Solyndra and SunPower having a major presence in Silicon Valley. The last two sectors I want to focus on are the hospitality and retail sectors. Both have fared poorly and remain, I believe, in a difficult situation for different reasons. The hotel industry has always been more sensitive to economic fluctuation, so it's no surprise at all that it has suffered the most during the past 3 years. In San Jose, the April hotel occupancy rate was just under 55%, down 2% from 2010. The average daily room rate was $121, a $7 increase over the prior year. In 2010, 49 of the hotels that responded to the assessor's request for financial information received a reduction in their assessed value. Hopefully, as the economy improves and corporate travel budgets increase, so will the hotel industry. However, technology, video and teleconferencing is providing a viable alternative to expensive and sometimes unproductive travel. The retail sector. This is one sector that I believe will never fully recover. The industry is facing 2 or 3 major problems. First, consumers who are over-leveraged due to excessive credit card debt. As foreclosures tighten credit and bad debt collection continues to press consumers, there has been a limited ability to shop. Second, the retail sector was terribly overbuilt. In the last decade, there was a glut of strip and power centers and malls built to accommodate what turned out to be the absolute peak of the consumer market during the dot-com boom. Third, it was built upon the framework of an old model that people would walk in the front door of a store and shop. While there are several reports about increasing prevalence of online shopping, traditional brick and mortar stores all point in the same direction. Online sales are growing more than twice the rate of in-store sales, and that trend is likely to accelerate. The combination of these 2 factors will result in 2 major types of real estate experiences. The high-end retailers that offer not only a shopping but an entertainment experience like Santana Row and Valley Fair, combined with discount retailers in power centers anchored by major national credit tenants like Target and Costco. It truly has become a survival of the fittest in brand name retailers as Mervyn's, Circuit City, Kmart, and recently announced Borders Books continue to disappear. I did not want to end this look on the economy on a gloomy note. Led by the stock market, in which the Dow Jones has gone from 6,500 to over 12,000, the national economy is finally beginning to stabilize, and Silicon Valley appears to be the national leader in this fragile recovery. The NASDAQ is up, and office and R&D rents in Silicon Valley generally follow the NASDAQ. In the San Jose Redevelopment Agency area, the stock value of the 15 largest publicly traded companies rose 81% last year, and a number of these companies have plans for expansion, and indeed today are expanding. A survey of the CEOs of 150 Silicon Valley companies published by the Silicon Valley Leadership Group was positive and encouraging. In addition, a report from the Forrester Research projected that spending on information technology in the United States will grow 8.4% this year, 2% higher than forecast just a year ago. Plus, for the first time in a while, a number of companies in Silicon Valley are proceeding with IPO offerings, which were virtually non-existent for a couple years, which is an excellent indicator that Silicon Valley is on a path toward a solid recovery. So I believe we are rising from the depths of the worst economic decline in my lifetime. With that, I'll be happy to answer any questions you have. Yeah.
Nice presentation. I just want to know, my house value, like everybody in here, has gone down and my tax bill goes up. Why?
Well, your assessment hasn't gone up. Your bill has gone up. And I get asked this question a lot. Proposition 13 says your assessed value cannot go up more than 2% a year. as a cap. Last year it was negative, so everybody that owned property, no matter what type of property, myself included, our assessed value went down, I think it was 2.43%, to reflect the negative California Consumer Price Index. Your bill goes up because the water stuff, the school bonds, the parcel taxes, and all that stuff. Prop 13 doesn't say your tax bill can't go up. It says your assessment can't go up. So I will bet you that this year we proactively reduced the assessed value on 124,000 properties. Took $26 billion off the assessment roll at the time we closed the roll 3 weeks ago. Okay, that was proactively, not reacting to anything. Last year we reduced the assessed value on 118,000 properties, took $24 billion off the assessment roll, and we got 12,000 appeals on top of that. Yeah.
Could you comment on the impact or potential impact of failure to raise the debt ceiling at the national level on the economy?
That isn't my area of expertise. I think it's tragic, but I would make some possibly unwelcome political remarks. Yeah.
You're mentioning practically every area. What is the projection in South County, like Gilroy, Morgan Hill area?
The bloodbath is here. Gilroy, Morgan Hill, East San Jose, and Milpitas. You've got the highest number of foreclosures, the biggest drop in assessed values. What happened in this market is that the growth areas, the ones where the condos and townhomes and lower priced houses were being built, they're newer, and they were the people that were borrowing subprime loans to have houses. So the more stable areas that had homes built a while ago, like where I live in Sunnyvale, there was less of a problem. Gilroy is the poster child for the worst that happened in Santa Clara County. Now, we're seeing some improvement of that, and the reason we're seeing some improvement of that is because the values got so low that people are finding a place to buy. One of the problems is that there's a lot of investors out there with cash that are buying them, and that doesn't provide for the stability in the community I think you want. Well, thank you very much. You can clap now. You don't have to. I'd like to say this. Thank you. I publish an annual report every year, and it's not a slick report. It's got my picture in it. That's the only slick part about it, I guess. But there's massive statistics on cities broken down by 15 cities, by school districts, and all that stuff. This is also online, by the way, but if you would like a copy of it, we're publishing this next couple of weeks, our 2011-2012 version. Give me a business card, write annual report on the back, and I'll make sure you get it not only this year, but future years. You can also get it online. If you already receive it, don't give me a business card because you're going to get one in about a month. Thank you.